Hello everyone, this is Sebastian McMahon from IA Financial Group, back from vacation and now with you to cover the week ending July 21st, 2023. So we'll recap the last month or so here in this review, but starting with the markets, negative on the week for bonds, higher rates, TSX higher, S&P 500 also higher, Nasdaq a little bit lower. We've seen some divergence between cyclicals and technology and also defensives over the last few weeks. There's been ample momentum on technology, as you can see from the Nasdaq here, 34% gain year to date in the US dollars. Of course, it's a handful of names that have been pushing the index much higher this year. The importance of active management once again in full display. I mentioned that. I'll discuss that in a few minutes. Other than that, price of oil very much stuck in the range of about 65 to 80 bucks since the beginning of the year. Now we're at $75. When we look forward over the next few years, we still expect the price of oil to continue to trend higher. Now maybe at the closing the high of the year to date range here. So let's see what happens over the next few weeks and months. Canadian dollar up about 3% on the year, and the price of gold quite volatile, but still up 8% since the beginning of the year. So maybe recapping the action in July, Bank of Canada hiked again. You've all seen that in the news. That's two hikes since the end of the pause. The pause was very short-lived. Announced the pause in January, saying that now it's time to wait and see what the data are telling us about the impact of all of these hikes. Have they done enough? Not enough. Well, they decided to come out of the pause in June. We've been somewhat critical on the timing of coming out of this pause, although only time will tell if it was the right thing to do or not. But Bank of Canada clearly here is not convinced that inflation will will converge back to target in a sustainable way, a target of about 2% over the coming months, quarters, and years without some more tightening. When we look at forward indicators on our end, we see that monetary policy seems to be working, just a matter of time. It takes between 18 and 24 months for monetary policy to do its thing, and it's 18 to 24 months following every single hike or cut. And remember that now we're in July of 2023. It was in July 2022 that we had the strong acceleration, the 100 basis points of hike in one meeting. So 4 hikes in one. That was 12 months ago. So likely it's going to take some time before we see the full impact. But again, only time will tell if more tightening was effectively necessary this summer. But when you look at inflation, it's kind of a mixed bag, because last week we got inflation in Canada 2.8% on the headline. So you could say, well, problem solved. Now we're between 1 and 3%, so we're at the target. Not so fast, and the Bank of Canada is the first one to tell us to not celebrate too quickly. Core inflation is also sliding down, it's still above 3%. Month over month, we've seen a few months of slowing down now. Is it enough? Well, when we look at the details of inflation on the next slide here, you see that the contribution from gasoline prices for the deflation was pretty important. So year over year, inflation at the pump was a negative 20-some%. So that's a very strong headwind to inflation. Now we've seen prices at the pump maybe stabilize and even grind higher over the last few weeks and months. So we might lose this headwind, and it could start to fade away and become a headwind later this year. And on the right, you have food inflation, which has come down a little bit from the 10% level, but still at around 8% plus. Remains an issue. So the perceived inflation from households remains strong. You and me, when we go to the grocery store, we still see strong inflation there. So it's a bit of a mixed bag. And before we get back sustainably to about 2%, we still need to see a monetary policy operate over the next few quarters for sure. If you look at the contribution to inflation from all of the components, so here again, I use this chart often. You've seen that in the past. All of the colored areas, they sum to the total, which is about 2.8 right now. What you can see is that the red part, transportation, so that's the price of gasoline, it was detrimental year over year, so it was a deflationary factor. But when you look at food and when you look at shelter, so the blue and the gray part on this chart, you see that it's pretty sticky. And interestingly, I mean, it's been discussed ample times in the media recently, I'm sure you've heard about it, but the fact that monetary policy is getting tighter and tighter means that mortgage payments are getting higher, at least the interest payments on mortgages getting higher, and this is an impact on the cost of living, and this is inflationary. So raising rates raises inflation. So it's a transition environment that we're in right now, but still you need to account for that, and this will mean that inflation will remain sticky for a while likely. And we've been mentioning that over the year that we could see a trough for inflation during the summer. The summer months, we could see inflation fall below 3% and then jump back again. Well, this is the chart that you see here. When you look at all of the month over month increases in inflation and you do scenarios and you just project that, well, the mathematics were suggesting that we would see this fall in inflation. It was already penciled in. But now, since we've seen an acceleration in inflation in early this year, month over month, and we still see the potential for having sticky month over month inflation figures, we could well say at the end of the year that the trough in inflation was in June, and after that it went back up. So there's still an important risk that we do see that if we continue to see 0.3, 0.4, 0.5% month over month on inflation, and a lot of that depends on gasoline prices, which have rebounded recently. We could see inflation start to creep back up and, probably give support the argument of the Bank of Canada that it was an interesting, or at least an important decision to continue with some tightening. So again, lots of uncertainty, but it was predictable that inflation would come this low during the summer, but now the risks are clearly tilted towards a rebound by the end of the year. Now, active management is always key. We always discuss that here at IAGAM. Well, two reasons here why this year active management is more important even than in other years. On the left, as I mentioned earlier, S&P 500 up about 15% this year, mostly because of the AI stocks or AI linked stocks. As you can see here, Meta, Amazon, Apple, Microsoft, Google, Tesla, and Nvidia. All very important names in the index. About 25 to 30% of the index is made up of these names, so it's quite important. And since the beginning of the year, this was up 58%. So if you remove those 7 names and you look at the remaining 493 companies, you have a return about 4% this year, which is more in line with the expectations that we had at the beginning of the year. So again, you can never predict these things, but the AI team is very important. Can we see a reversal? Maybe, but you need to acknowledge these momentums. So active management is key. When you see momentum like that, we don't do the stock picking. It's in the asset allocation team. Our PMs are doing that for us, but it's important to recognize these. It's important to be in the right teams at the right time, because if you don't use active management, well, you can find yourself lagging behind your peers quite easily. So index investing is interesting as a strategy, but active management, we believe, is the winning strategy here. On the right, it's more about the sentiment moves. As you can see, it's the bull versus bear spread sentiment of investors. Sentiment was pretty downbeat a few months or years ago, and now maybe we are nearing a reversal point. Maybe investors are too optimistic here, so you see the bull to bear spread is nearing the tops of the last let's say 8 years here. When you look at the VIX is pretty low, still below 14, so markets might be priced in for not perfection, but lots of good news. So it's always in these moments that volatility can make a comeback if you have the slightest negative news that just hit the tape. So active management is key on the stock picking and also on the asset allocation front. The risk on or risk off, stocks versus bonds, regions. So this is what we do daily. So what to watch next week? GDP growth for May in Canada. In April, it was 0%. Interestingly, Canadian economy is pretty resilient. Of course, demography is helping a lot here, but no month was negative on the growth front in 2023 so far, which is pretty impressive. Bank of Canada summary of deliberations from the latest decision. In the US, we'll have the Conference Board Consumer Confidence Index, which should creep up a little bit. Fed decision to a 25 basis points hike is expected next week on Wednesday, so we'll see if it comes to fruition. Q2 GDP growth should be at 1.8%, not too weak, but still on the weak side. And core PCE inflation 0.2% month over month in June. So inflation followed closely by the Fed. So that wraps it up for the week. If you want to find us, ia.ca/economy for this review and for the podcast. If you want more sophisticated institutional content, you can go to iagam.ca/insights. There we publish the monthly. There's also the Keys to the Market, which is a weekly publication, and ample material from my colleagues too. So iagam.ca/insights is an interesting destination for you. So that wraps it up for this week. Thanks for following us, and I'll be back again next week.